All right, so the union budget, every year it drops, and it's just this mountain of information, right? It can feel super overwhelming, packed with all these numbers and policies that seem like they're happening a million miles away. But what if we could just cut through all that noise, get straight to the stuff that actually affects you, your business, and most importantly, your wallet? Well, that's exactly what we're going to do right now. Let's dive in. So here's the game plan. First, we're going to take that big picture, 30,000-foot view of the nation's finances. Then we'll zoom right into the major plans for fueling economic growth. After that, we'll see what's in store for small businesses. And finally, the part you're probably waiting for, we'll get right down to the changes that hit your personal finances. Simple as that. Okay, first things first, if you want to understand any budget, you've got to start with the absolute basics. Where's the money coming from and where's it all going? I mean, this is the foundation for everything else we're going to talk about. So check this out. The government's biggest source of income, it's not actually taxes, which is what you might think. It's borrowings. For every single rupee the government gets, a massive 36 paisa comes from borrowing. And believe me, this reliance on borrowing is a huge theme that we'll see pop up again. After that, yeah, you've got your usual suspects, GST, and then income and corporate taxes. Okay, so where does that rupee go? Well, a pretty big chunk, 26 paisa, goes right back to the states. But look at this. The second biggest expense, 10 paisa out of every rupee goes just to pay the interest on all those past borrowings we just talked about. When you add that to the money spent on defense, you can see how a huge slice of the budget is already spoken for before they can even think about funding new stuff. And this gap, between what the government earns and what it spends, that's what we call the fiscal deficit. The new target is 4.3% of GDP. And what that number tells us is that there's a real strategic move here to kind of tighten the belt and get a better handle on all that borrowing. All right, so we've done the financial checkup. We know where the money's coming from and going. Now let's get to the exciting part, the strategy for the future. Where is the government placing its big bets to really power long-term growth? Okay, this number is huge. It's honestly one of the biggest headlines from the entire budget. We're talking about capital expenditure, or CAPEX, hitting 12.2 lakh crore rupees. And just to be clear, this isn't money for day-to-day stuff like salaries. Nope. This is pure investment in building actual things. Think roads, railways, ports, assets that are going to fuel the economy for years. And it's up from 11.2 lakh crore last year, so you can see this is a really aggressive, continued push. So the big question is, where is this mountain of cash actually going? Well, the strategy is basically four-pronged. We're talking a big push for infrastructure and transport to improve connectivity. Then there's a focus on boosting manufacturing in our MSMEs. Third, making sure our energy supply is secure. And finally, turning our cities into real, powerful economic engines. Now let's zoom in on one of those points, MSMEs, micro, small, and medium enterprises. We always hear them called the backbone of the economy, and honestly, it's for a really good reason. They create a ton of jobs. So it's great to see this budget really has a dedicated focus on making life easier for them. But why the special attention? I mean, what are the big problems here? Well, for years, small businesses have been struggling with two major headaches. First, getting their hands on cash when they need it, liquidity. And second, just trying to navigate all the crazy complex paperwork. So let's see how this budget plans to tackle that head on. So the plan has 4 key parts. Step 1, speed up GST refunds. This is huge because it means businesses get their own money back into their hands faster, which is everything for cash flow. Step 2, push digital lending. This makes getting a loan way easier, way faster, and often without having to put up collateral. Step 3, expand credit guarantees. This basically tells banks, hey, it's less risky to lend to small businesses now, which should get the money flowing. And finally, step 4, slash the red tape. Less time on paperwork means more time actually, running and growing the business. Simple, right? All right, deep breath. This is the section I think most of us have been waiting for. We've talked big picture, we've talked about businesses. Now let's talk about your money. What does all this actually mean for your payslip and for your investments? Okay, so the biggest story in personal tax right now is this choice you have to make between 2 completely different systems. It's like a tale of 2 tax worlds. On one side, you've got the old tax regime. Think of this as the deductions world. You can seriously lower your taxable income if you've got HRA, a home loan, ADC investments, all that stuff. Then, on the other side, you've got the new tax regime. This is the simplicity world. It has more tax slabs, so the increase is a bit gentler, but, and this is a big but, you have to give up almost all of those deductions. And that, of course, leads to the million-dollar question that every single person earning a salary is asking. Which one should I choose? Okay, this chart really breaks it down and makes the choice pretty simple. Here's the bottom line. If you don't have a lot of deductions, maybe you're just starting out, you don't have a home loan, you're not maxing out your ADC, then the new regime with its lower tax rates is probably going to be better for you. But if you're someone who claims everything, HRA, home loan interest, the whole ADC shebang, then sticking with the old regime will almost certainly save you more cash. The key takeaway here? You actually have to sit down and do the math for yourself. It's all about tax planning now, not just tax saving. Okay, so that's the income tax picture. But let's move beyond just your salary for a second. There are a few other important updates you need to know about, especially if you travel overseas, invest in gold, or trade on the stock market. So first up, some good news if you're spending money abroad for certain reasons. The tax collected at source, or TCS, on overseas spending for education and medical needs has been brought down to 2%. What does that mean in simple terms? It means those specific expenses just got a little bit cheaper, which is always nice. On the flip side, if you're a stock trader, there's a small pinch. The Securities Transaction Tax, the STT, is going up for anyone trading in futures and options. Now, it's a tiny percentage, but if you're a really active trader, that's a direct hit to your costs on every single trade. Okay, investors in sovereign gold bonds, listen up because this is a really important clarification. For a long time, there was some confusion, but now it's crystal clear. To get that amazing tax-free benefit, you absolutely must hold the bond for the full 8 years until it matures. If you decide to sell it early on the stock exchange, any profit you make is now taxable. This is a huge deal and changes the calculation for a lot of investors. Whew. Okay, so we have covered a ton of ground, right? From the big national economy all the way down to the nitty-gritty of your own investment portfolio. So let's pull it all together and boil it down to the most important things you need to remember. So here it is in a nutshell. What are the big takeaways? 1. The government is making a massive bet on infrastructure to drive long-term growth. 2. There's a major and very real focus on making life simpler for small businesses. Better cash flow, less paperwork. 3. For individuals like you and me, the homework is clear. Figure out if the old or the new tax regime is better for your wallet. And 4, if you're an investor, you've got to keep these new rules for SGBs, STT, and TCS top of mind. When you step back and look at the whole thing, this budget is really trying to walk a tightrope. It's an attempt to strike that very careful balance between pushing hard for economic growth on one side and keeping a tight grip on finances on the other. And that leaves us with one final thought to chew on. We've decoded the budget, we've broken it down, but the real question now is, what are you going to do with this information? With a whole new set of tax choices and investment rules on the table, how are you going to adjust your own financial strategy for the coming year? That's the real homework. Thanks for joining me.